Module 5 deals with liabilities in the equity section of the balance sheet. So we'll be talking about current liabilities, long-term liabilities, contingent liabilities, shareholder equity, and we'll also be looking at some current ratio relative to accounts payable and wages payable. Current liabilities basically are amounts that are due to be paid within 1 year or less. So they are the alter ego of current assets. Here are some types of current liabilities. The most common is accounts payable. Those are amounts due to your vendors for merchandise and goods purchased. Then we have notes payable, but only the amounts that are due within 1 year are considered to be a current liability. Any amount of a note that's after 1 year is considered to be a long-term liability. Then we have accruals. These are amounts that are owed at the end of a period but have not been paid out yet and must be accrued to properly match the revenue with expense. Wages payable, vacation pay, income taxes, and interest expense are the most common types of accruals that are made at the end of the period to reflect what is owed by the company to be paid in a future period. Then another type of a current liability is a security deposit. Perhaps you have customers who have left money with you as a security for some particular reason, clean deposits, things of that nature, and those are not really your money. They're money that you're holding on behalf of the other person, and they are classified as a current liability. Now we have some current liability ratios that are important to us because, again, as we learned, we wanted to manage our current assets. We also want to manage our current liabilities. And one of these is called the current ratio, and the other is the working capital. These are both important in managing the total working capital of the organization. So let's assume we have current assets of $500,000 and current liabilities of $240,000. The current ratio is calculated by dividing current assets by current liabilities, or in this case, 500,000 divided by 240,000, or 2.08. This means we have twice as many current assets as we have current liabilities. Now, this ratio differs from the quick ratio we saw earlier in the fact that in the current ratio, we include all types of current liabilities, including inventory and prepaid expenses. If we look at the working capital, it's called 500,000 less 240, or $260,000. So this is the free assets that we have available to use to operate the business and would have available to us after we paid off all of our current obligations. And again, I emphasize these ratios are important to us because we need to use them to manage our working capital and to make sure that we have sufficient liquidity on hand to pay our obligations when they come due.